Welcome to 443 Equity Analysis. My name is Joe Perfetti. I'll be the instructor this semester as we go into our grand online experiment. This class will be taught online this semester. We will not meet in Van Munching Hall. Everything will be done via Zoom and online assignments. So we're going to do our best to kind of take most of the experience that you have gotten in the real world and to put it online. But a few things will be changing as we go through the class. Equity analysis is essentially going to be understanding the perspective of a sell-side analyst. So how does Wall Street pick, select, value companies? How do we understand the external environment that a company is in? How do we look backwards to help us understand looking forward? How do we value a company? And how do we come up with the multiples that you see companies trading at? Those will be the things that we will focus on. If you look on ELMS, all of these classes, including this one, will be recorded. We're going to use Zoom as our primary method this semester. So one of the things, and I see, looks like everybody has done this, please use your real name when you log into Zoom. That way I can see you virtually and we get to know each other's names. And also, when we do the attendance records, the name that you have in Zoom will be important for the attendance records that we're going to keep track of throughout this semester. So I want to start with a couple things from the syllabus. I'm going to go ahead and share my screen here. So I am teaching 4 sections of 443 consecutively. There's an 11 a.m. section. This one's 12:30. Then I have a 2 and then a 3:30. It's about 45 students per section. This is my name. That's my email address, cell phone number. Virtual office hours is what we're going to have via Zoom. Won't be on campus at all. These are the 3 TAs for the class. TAs are very important because they're going to be doing grading and they're also going to be doing virtual office hours. The one thing about the TAs for 443 is all of them are undergraduate TAs who have taken the class. So they also understand the content and have been in your shoes in the last couple of semesters. So in terms, again, of the valuation we just talked about for the class, you can kind of read this, but a few very important things I'll just highlight on the syllabus. Again, this is an online class, which means sometimes we're going to not have lectures. The cadence that I'm going to try and work on this semester is Monday generally will almost always be a lecture. Some Wednesdays lectures, some Wednesdays exercises, and they'll be clearly laid out when we're going to have a lecture. Attendance is going to be important, but not mandatory. And I'll put an asterisk on that. So my feeling is this, and I want to be very clear while we're still in the drop ad period. Most finance classes, particularly this one, build upon each other. So this is a terrible class to basically show up one time, don't do anything, show up for exams and skip everything in between. It's not going to be for you. There will be weekly assignments, right, in this class, and they build upon each other, and it's all real world. So cramming at the last minute for a final exam generally doesn't work. And particularly as we go online, it's going to be hard to maintain those connections. So here's how attendance will work. I'm not going to grade attendance per se. It's your money. If you don't want to show up, I would recommend you drop the class, but regardless, it's up to you. But if you don't regularly attend classes, and we're going to basically use Zoom to manage attendance, where there'll be a roster spit out of the report of all the Zoom attendees, and you have to be in the class for at least 60% of the class time, then anything less than 90% attendance over the semester without excused absences, you lose the ability to get extra credit and you lose the ability to opt out of the final exam, which is historically proven popular. So basically it can't hurt you to not show up. You'll just have to take the final exam and you won't be eligible for any extra credit. Okay. So it's really kind of help me while I'm doing attendance. So basically, in terms of excused absences, again, I recognize we're in a COVID world. So here's the point. I'm going to give you the same grading concepts that I'm going to explain to the TAs. Okay. So first grading concept that's very important to me is that I have about 168 students registered right now. I'm not going to do for you anything that I wouldn't do for the other 167 people in the light of day. So my grading is going to be basically to treat everybody fairly, treat everybody the same, and be as consistent as possible. So that's first grading concept. Second grading concept is we take deadlines seriously. So generally, before deadlines, there's flexibility for exceptions. After deadlines, there's limited, if no flexibility for exceptions. And this applies to the late assignment policy. If you miss a deadline with a late assignment, we're not going to grade it. You're going to get a 0. Okay. Same thing with it, whether it's a group project, whether it's an individual project, don't even bother to turn it in. It's not going to be graded. You're going to be treated like an adult. But if it's before a deadline and you get written permission for an extension or something from a TA or myself, then we will be flexible. So let's just say you're dealing with a sick family member. You're dealing with a job interview, something like that. You need an excused absence for the class. You need an extension on a deadline. Email us, talk to us in advance. You're probably going to get it. Okay. But if it's, hey, I did a job interview and I forgot to come to class and I didn't tell you about it, I didn't turn in my assignment, then I'm going to be like, I hope you got the job, but you're not going to get credit for the assignment. Okay. Regardless. So again, talk to us before deadlines. We take deadlines very seriously. I'm going to treat you like an adult. Right. The other thing that's going to be important about this class is you're going to become Bloomberg Certified. And that's going to be very important. I've also, compared to last semesters, I have upped the grading to 50% of your grade will be based on group projects. It used to be 40%, now it's 50%. So you're going to be working on team projects. There will be 5 team projects that you'll be part of and the first one starts in 3 weeks. Okay, so very important to understand your teams, your team projects. There'll be homework assignments weekly. There'll also be a midterm and a final, which you can potentially opt out on. The cadence for the assignments, with the exception of Labor Day coming up, is generally the assignments are Wednesday assignment, Monday deadline. Okay, so generally do Monday 10 a.m. unless otherwise explained. And you'll notice when you look at the assignments in ELMS, a lot of them are blank. And the reason why is this is a real world class. So when I literally will look at headlines to create assignments. So if Nike's in the news, your assignment's probably going to be on Nike. Okay. So again, this is not Harvard Business School. All right. We don't deal with case studies here. And then the other thing that's probably very important is the grading policy. In this class, you have to use data. Okay. So general statements that you've probably gotten very good at your undergraduate career basically don't get any credit. So writing a lot of words gets you no credit on any exam, any homework assignment, any writing project. So you have to use numbers and you have to provide supporting data with all of your solutions. In terms of classes, generally they're going to be on Zoom. Each Zoom will be recorded. You can look at the Zoom link here on ELMS, and I'll also make it available on my YouTube channel, which you're welcome to subscribe to. So if you need to access the class and you want to go back to it or you couldn't make it, it will be on YouTube as well. Textbook. We're using a new textbook this semester. It's the 7th edition. You need the 7th edition. It changed. Last semester, if you bought somebody's 6th edition, then get a refund. Okay. You need the 7th edition. Okay. So your readings are based on the 7th edition. Project groups. You've already been assigned to a group. If you go to people, teams, you have already been placed into a team. There are 6 teams by sections, 4 sections, 24 teams. You are on one of these teams. Okay. So these will be your teammates for half the grade throughout the semester. So get to know them soon because it will be very important. Might be a couple shifts via drop add, but generally these will be the teams. Okay. Also, let's go back to the syllabus. Important things. One of the group projects is called the Bloomberg Trading Challenge. That to me is one of the most exciting parts of the semester. And for you, one of the grades that you're probably not going to like. So the 6 teams are going to use Bloomberg and starting next week to basically invest in the real world. So you'll be able to invest $1 million in the marketplace. You're going to be graded competitively. So in 6 weeks, we're going to keep score. Whoever has the highest portfolio value as a team gets an A. Whoever has the worst portfolio value of a team gets an F on the assignment. It's going to be 10% of your grade. So pure competition, whether you win by $1 or or $100,000. It's just forced ranking based on actual performance, investing in equities in the real world. Now, for those of you that get freaked out about this because you don't want to have an F on 10% of your grade, we'll restart halfway through the semester, and then we'll do it again in the second half of the semester. So there'll be 2 6-week sprints, okay? But the other thing is the class has extra credit. And so if you completely screw up in the trading challenge, you can do extra credit to make up for your grade, unless you never attend. The attendance policy revokes your ability to do extra credit if you don't attend 90% with at least excused absences. So that's the only other thing to be aware of. You will become Bloomberg certified this semester. Very important. And here's the breakdown of the grade. It's based on 100 points. 5% is getting Bloomberg certified, but I'll call it Bloomberg plus certification, because for this class, you also not only have to get Bloomberg certified, but you have to score 70% or greater on each section of the certification, because Bloomberg generally allows you to kind of click your way through the certification. I'm not accepting that. You actually have to, as you take the certification, you have to answer these multiple choice questions. If you don't get at least 70% right on each section, then I'm not going to give you credit for the Bloomberg certification. So when you're turning in your certification, not only must you turn in the certificate, but you must turn in the screen showing more than 70% for each section. 4 of the 5 group projects will be on each stage of the valuation. So in 3 weeks, you'll do an EIC presentation during class as a team. You'll get graded for that. In about a month, you're going to do one on historical analysis. Month and a half, you're going to do a group project, which will present in class valuation of a real world company. And then finally, near the end of the semester, you'll do one on multiples. There'll be a midterm exam and the Bloomberg trading competitions, the other 10% of the group projects, and a final exam, which you can opt out for. There's the attendance policy, should be relatively straightforward. Follow the honor code. Course assistant websites are permitted, or prohibited, I should say. Late assignment policy, again, if it's going to be late, it's not going to be graded. That's going to be pretty consistent throughout the semester. Again, if you have any special needs, including health related, just talk to us. Don't stick your head in the sand. Don't wait it out and hope that things get better. If you have problems, reach out. All right. We are going to try and be flexible. But as I said, help me help you. Do it before deadlines, and just treat us like adults will treat you like adults. And then there's basically 2 things that will matter to extra credit. One is the opt out of the final exam, which you can opt out if you basically show up for classes, you get minimum scores on your group projects and homework assignments, and you participate. You don't have to take the final exam, you just get the points. Okay, about 75% of the class opted out last semester. The other piece is we do something called an assignment replacement. All right, if you screw up an assignment, you can write a 500-word paper some point during the semester and replace that assignment with a perfect grade as if you had done it. So if you do screw up, you miss an assignment, or you do poorly an assignment, you can replace that assignment, one assignment throughout the semester, okay, by writing a paper. So that's basically the syllabus. I know I've been kind of monologuing here. Questions about anything as we get started? Just want to be clear on the expectations. Okay. All right. So again, back to sharing my screen. So a lot of what we're going to do this semester, very real world, will involve becoming Bloomberg certified and using the Bloomberg Terminal, also called the Bloomberg. Okay. So this is the pro tool used by Wall Street, right? Bloomberg is Michael Bloomberg's company. He's a billionaire because of this. He's got about 300,000 people that use this software every day. They pay $25,000 a year per person to use this software. If you work on Wall Street, this is the actual software that you would use. You're going to get to actually have access to the software for free as part of this class, right? So a couple things about the Bloomberg terminals. Normally, you would actually be taking the Bloomberg Terminal and software certification in a lab in Van Munching Hall. But due to COVID, you're not going to be able to go to Van Munching, and the lab is actually closed. So you can't even get to the Bloomberg lab. Now, the University of Maryland has 60 terminals. There's no university in the world that has as many Bloomberg terminal licenses as we do here at Maryland. Just to put it in perspective, Wharton's got 8 for their entire MBA program. We have 60. In fact, we actually have a Bloomberg lab. There's one of the very few in the world that has 32 terminals in Van Munching Hall 3505, which you are locked out of this semester due to COVID-19. So Bloomberg has been nice. Because it's such expensive software, they don't allow remote dial-in to the software. Can't access it remotely, got to access it live. But we're on their disaster protocol, which means they took our 60 licenses and they made them available online. So you have the ability to fully access this remotely over the web, okay? But a couple of licenses were taken out. There's about 55 of them available. We can have up to 55 students simultaneously accessing Bloomberg at the school online. Okay, that's how many licenses we have that are available for the online and you can access. Now, here's the thing. It's like Fight Club. Anyone in the school can potentially do this. We don't want them to know about this because if they're on it, you're not on it. And if you're getting blocked out, you won't be able to do your assignments. Okay, so even though you have this privilege this semester, let's keep this on the down low and not have the whole school know that there's this really cool tool they can access online, because it will just end up preventing you from being able to do the work. Now, I have 168 students registered for 443, and there's only about 55 of you that can be on at any one time. So what we're going to try and do is just say that during your class time, yours being 12:30 to 2 o'clock or so, you should be the only ones using Bloomberg on Mondays and Wednesdays. Okay, so during the 11 a.m. section, let the 11 a.m.ers log on. During the 12:30 section, Monday, Wednesday, should be primarily you. Now, we can't prevent other people from blowing this up, but generally during the week, log on during your class time. Tuesday, Thursday, Friday, weekends, nights, evenings, mornings, it's the Wild West. Okay, now I'll just let you know how Bloomberg is doing this. 55 people can be online. When person number 56, let's say Nathan McGregor is person number 56, and he comes in and logs in, and let's say Riley, is it Chupkala? I get that right? Close?
Krupkala.
Okay, sorry about that. So let's say Riley's on already, and Nathan is person number 56, it will kick Riley off. And let's say Sarah Sherman logs in and Nathan is in, then it will kick off Sam. It doesn't kick off the person who last logged in. It kicks off the person who first logs in. And it doesn't lock you out of accessing Bloomberg. So what'll start to happen is if too many people try to go on at once, you're just going to randomly get knocked out of the software because other people are trying to use it. It's not the ideal protocol, but it's the way Bloomberg has implemented it. So the question becomes, how do you access and get the Bloomberg data? In our course, if I go to Zoom, share screen, in the course, there's a file section, and we're going to be going through this lecture note in just a few minutes. That's where I'll put the lecture notes. There's a folder called Bloomberg under Files and Student Terminal Access from Home. This it gives you the instructions on how to log in remotely and how to create your account. Okay. Now, the other thing is you're going to have to become Bloomberg Certified. So in the assignments, under Bloomberg Certification, this is the BMC class code. Now, generally, to become Bloomberg Certified, what people do is you go to the terminal and you type in BMC and you get certified through the terminal. But since we have a limitation how many people can log in remotely to the terminal, it's going to be hard to get 8 hours of time to get certified going through all the Bloomberg stuff through the terminal remote. So Bloomberg also offers an online certification through the web browser, right? Normally without a terminal. It's in that link. Normally, when you register here as a learner, it costs $149, but they've given a deal to the University of Maryland, as we're the largest Bloomberg user in the world. If you register an email that's a umd.edu email, it's free. Okay, so when you register, whatever at umd.edu is the email you want to use. Otherwise, when you register, they're going to ask you for $149. And I don't want anybody to pay $149 for something that's free. Okay. And then you can actually take the certification right here through the web browser for free. Okay. And it explains how to sign up an account so you can use the software, which will be separate. And that's the account here. Questions? I'm throwing a lot at you.
So with that, you won't be kicked out if somebody else logs into it. It's just
if you go in through the browser, see if I can go in, log in, then you'll end up with a screen that looks something like this, and you'll see the requirements are these 4 sections, and then essentially you just start clicking through and just watching and reading and answering questions about it. Okay, so this won't kick you out. But as I said, to go through it here and not pay $149, make sure you register with an @umd.edu email. Okay, and then you can take it online. And then when you're going through these sections, what they do is they give you kind of a virtual terminal where they show you stuff they want you to see. You're not using the full terminal, but then they'll ask you questions about it. And by the way, when they ask you a question, they don't let you go back and unanswer it. So there's the 70% rule comes in. So you got to get 70% of the questions they ask you right. So just clicking through doesn't help you. And when you get to the quiz, you can't go backwards and relook at what you've seen. So you do have to pay attention to what you do. Okay. Anyways. And then I didn't explain this, or didn't require this, but there's terminal basics, which you might want to look at as well, which basically explain how to use the terminal, which we will cover in class. Other questions? All right, so back to gotta get certified, assignments, where you get your class code and link to do it online. Here, files, Bloomberg folder, this is how you can access the server or the software remotely and build an actual Bloomberg account for free. So back to this. When you get in, as I said, this is the pro tool on the market. So for example, one of the things a trader would do is they would type in Daybreak, D-A-Y-B. And this is the cliff notes for what you need to know for what's going to happen every day. So it's kind of like, if you want to know what's going to be on the mind of Wall Street, here's the summary that everybody on Wall Street starts their day with. What do you need to know? What are some of the key stories? What are some of the things that news that's going to hit the day? What are some of the, scroll down, the most important data releases that are coming up through the day? Just summary on key industry items, whatever. So this is curated. Another thing you would do is you would probably have a screen called Top. Top is literally that. It's top news. Curated news from everything. And they always have a top 4 to tell you what's the most important thing real time coming into the terminal. So you can monitor news. You can put in your own searches for events. Then you can go to VRUS and you can check out the latest on the coronavirus. All right. So this is the actual Wall Street dashboard that they're looking at the coronavirus, which companies are impacted by this, what indicators you're tracking, where are the outbreaks, resources to get to other data sources, and research and various dashboards that are on the coronavirus. This is a summary. So again, a lot of information here. There's about 1 million companies in the database of real-time information, stocks, bonds, commodities, currencies, a lot of stuff in here. We're going to use a sliver of it, okay? And we're going to do equity analysis. But nonetheless, this is the tool that we're going to use for all of your assignments. So very important you start the process to get an account this week, because your first assignment due next Wednesday is going to involve using the terminal. Okay. So back to equity analysis. So one of the things that we'll look at is, just an example today, I was talking with the past section about the S&P 500 and why the S&P 500 is going up so much despite this horrible virus out there. Okay. And in order to understand what's going on with the S&P 500, I'll ask a question. What's the difference between the S&P 500 and the Dow Jones index? What's the primary difference between those two indexes? Does anybody know?
Does the S&P average more stocks than the Dow Jones?
So it's got 500 companies versus 30. So that's one difference. What else is, there's another fundamental difference between the two. I know. It's actually the way they're calculated. The Dow Jones index literally adds up all the share prices of the 30 companies. And then they divide by divisor, but it's basically, it's an addition of the share prices. Okay. The S&P 500 index is a weighting based on the market cap of the companies. So a company with a big market cap has a much outsized difference with their share price changes than a company with a small market cap. So I want to show you this. So I'll go to this site, and this is for today. This is the S&P 500 index, which again has 500 companies in it. Apple represents 7% of the entire index. So Apple's change in share price, 7% of the index change. 499 other companies, 93% of the index change. As a matter of fact, Microsoft is 6% of the index. Amazon is 5% of the index. Facebook is 2.4% of the index. And Google is about 3.3% of the index. These 5 tech companies represent 1/5 of the S&P 500 index. So 5 companies are 20% of the index. 495 companies are 80% of the index. All right. So if you wonder why the S&P 500 has been doing well, despite how screwed our economy is, it's because Apple, Microsoft, Amazon, Facebook, and Google have seen their share prices go up 60% in the last 6 months. And they are having an outside impact on the marketplace. I'm going to show you a different version of this. This is a graph or a chart, or what's a chart? Chart, graph, whatever. Here's a map of the S&P 500. So the total value of the index is the box. And then the size, the relative weightings of the companies are shown. So this is tech. This 1/3 of the index is tech. This is healthcare. Tech and healthcare are almost half the index. And they got financial services. And if you have to look, here's airlines. That's the entire airline industry. Those 5 companies. So I'm telling you, like when Delta and American have been screwed, it's like a gnat on a fly in that their share prices are going down like 50%, but it doesn't really affect the index as much as Amazon, Microsoft, and Apple going up, which has a much bigger outside impact. And this is just a representation that our economy has become much more tech driven. And the reason why the market is high is not because Main Street's completely screwed. It's because the index represents tracking stock for the NASDAQ. But again, things that we're going to start looking at when we analyze companies and industries. So one of the reasons why people are less worried in this bull run about the market falling is these are the companies that have to fall. You got to take hits from Microsoft, Apple, Facebook, Google, Amazon, Walmart, like those, Visa, MasterCard, those are the ones when they start falling. That's what's going to take the bottom of the market. It's not when John Deere or Caterpillar or any of these tiny companies over here, because again, it's weighted by size. Now the Dow Jones is different because the Dow Jones adds up all of the companies. So in a way, the Dow Jones is going to be lagging the S&P 500 because the S&P 500 is very tech heavy. The Dow Jones, it's not as much because you just add up the company share prices. So again, just start to understand what's going on with equity analysis. All right, pause, questions. So let's go back to Bloomberg. So Bloomberg, the S&P 500 index, the ticker is XPX, SPX, and you go down here, and this is the index. So today, 3504.36, down $3.65, real time. So one of the screens you might want to look at is IMAP. So you type in IMAP or click on IMAP, and this is, as it sounds like, a map of the market. So instead of the boxes, it's a circle. So you can see which industries and sectors are going up. So today the market's down a little bit, but why is it down? Communication, financials, industrials are down. Tech hardware, healthcare up. Okay. So again, you can start to see what's going on in the different parts of the industry. So, and you can drill down on any of these. Right? So the question is, what's actually driving this? How do we actually price this? Right? And how do we determine the value of the companies? Well, this is where the analysts come in. And on Wall Street, there are two types of analysts. There's a group of analysts called the buy side, and there's a group of analysts called the sell side. So I'm going to pick a company. Take Nike as an example. It's all about the shoes. So ticker symbol NKE, US equity. And this is their share price today. They're 111.75. And one of the things that I can do is if I look at the buy side, I can see who owns Nike. In fact, there's a screen in Bloomberg called Own, Ownership Summary. And these are the institutions that own Nike. And I can see the types of institutions that own them. I can see who owns them, where they're owned. I can see shares of insiders. And if I click over here to current, I can actually see a list of all of Nike's institutional shareholders as a scrollable list from who owns the most Nike shares all the way down to who owns like 10 Nike shares. And so, by the way, if VFH Captive Insurance Company, which owns 10 shares of Nike and just bought them, decides to sell them, well, no one's going to care about that in terms of Nike share price. Whereas Nike's largest shareholder is Vanguard, and they sold 1.368 million shares of Nike recently. That's actually going to drive Nike share price because they represent 8.45% of Nike. So this is a good example of starting to see for big companies, like this is the concentration of ownership of these big institutions. These are the actual owners, and these are the people that are going to determine a company share price. Okay. So let's say that you work for Vanguard and you're running this in this Vanguard portfolio, you're running this, I don't know, US growth fund for Vanguard. Picking a random fund out of the blue here. So this Vanguard fund is a relatively small fund. It's got 299 companies in it. Nike is one of them. And it's worth $53 billion. Okay, relatively small fund in today's world. And these are all the companies that are in this Vanguard fund. And you're the Vanguard fund manager. How do you keep track of 299 companies and all their competitors in real time to figure out what you're going to do if you're an active fund manager? And you don't have to answer that question because the honest answer is you can't. There's just too much going on for one person or even a team of people to keep track of everything. So what you do as a buy side person is you hire an analyst called the sell side to help you. So let's say I was tracking Nike. Then what I do is I go here, ANR, to the sell side analysts that work for the banks. So I hire John Kernan of Cohen, Sam Poser of Susquehanna, Kimberly Greenberger of Morgan Stanley, or Alexandra Walvis of Goldman Sachs, or Jim Duffy of Stifel, to basically help me understand what I should do with Nike. They're the people that create the buy, sell, hold opinions. As a matter of fact, there are 35 of them that Bloomberg gives access to for Nike. And they're the ones that are writing the buy, sell, holds. So of these analysts, you can scroll down and see them, right? 28 of these people say buy as of right now. Buys are worth 5 points. 6 say holds. Holds are worth 3 points. 1 says sell. Sell's worth 1 point. On a 5-point scale, these analysts are a 4.51 out of 5. Now, Nike share price right now is 111.77. It was 76 when we got on the screen. They also put 12-month target share prices. This is what the analysts think Nike's price is going to be in 12 months. Bloomberg averages these. The 12-month target price wisdom of the crowd average is 113.08. So basically, Nike's trading today at 111.76. In 12 months, the analysts think they're going to trade at 113. There's 1.2% upside in Nike The last 12 months, Nike's up 34%. So even though people like Nike, they don't like Nike beyond the current price because they've had such a big run up in their share price. So this is something that you start to think about in your portfolio. And these are the people that help you figure that out. Does that make sense? Questions about this before I go forward? Right. So next step, let's say I'm looking at understanding Nike. So I go back here to Sam. He's one of the analysts. So an analyst team is typically 3 people. You have the sell side analyst, you have an MBA, and then you usually have an undergraduate grunt. And their job is to cover all of these companies. Their coverage universe is actually pretty big at Susquehanna. So it's not just Nike, but they're looking at all these apparel companies. And they're writing buy, sell, hold opinions. So they become specialists in these industries. In fact, if you want to read their research, you can click over here, get access to their research. Again, if we have subscription rights, these are the pluses for Bloomberg. The other thing you can do is if you want to know who Sam is, this is Sam's LinkedIn version on Bloomberg. Now, I want you to understand this, is that this green dot means that Sam is online. That's his phone number. That's his real email address, real world contact information in New York. But the key is this green dot means you can IM him. So little known fact about Bloomberg is you actually have access to a who's who of real-time communication with just about any person of importance in the financial world. Because Bloomberg's a system of record and you IM him, he's probably going to respond, at least initially. And when he realizes you're a student who can't help him, he'll probably block you. But I do want to let you know that this is a very powerful tool for communication because Bloomberg is a system of record. And so these people are talking to each other all the time on Bloomberg, and trade confirmations can actually flow through here as well. So you get their real information through the system. You can search people. But that's not the point I want to make. The point I want to make is this. For each of these companies, they create a spreadsheet. In the spreadsheet, they forecast Nike's financial performance. Now, if we had a subscription, we could actually download Sam's actual spreadsheet. Now you can click on this and request it. They'll probably say no, because you have to pay for this from Susquehanna. Got to be a Susquehanna client. But here's the point. What Bloomberg is doing is it's aggregating all of the spreadsheets forecasting Nike from all these analysts. The screen, EEO, Earnings Estimate Overview. This is one of the most important screens we'll use throughout the semester. This is the wisdom of the crowd, real-time consensus estimate database for Nike going forward. So last year, Nike's revenue, $37.4 billion. This year, 5/31/21, Nike's revenue, $39 billion. 22, $43.4 billion. 23, $48 billion. 24, $51 billion. This is the EPS forecast. This is the Ebitda forecast. This is what the market is expecting Nike to do on an annual basis and on a quarterly basis. So when they report their earnings, 8/31/20, the market's going to be looking later this month for 42 cents per share of EPS and $8.967 billion worth of sales. And Nike, EBT, company events, is going to report earnings on September the 22nd at 4:15 in the afternoon. This is where you get the link to the conference call. This will be replaced with a pin, and this is how you can actually dial into the call and get unmuted. Anyhow, back to Nike. So forecasted expectations drive Nike's share price. This is the role of the sell side. Questions? Comments? Any of this? All right. So then we'll continue on back to our content. Lecture 1. As you're going to read the book, one of the things McKinsey talks about, I call it the 4 cornerstones of value creation. These are the things that drive value. The most important things to understand this semester. So those are our guides. The first one, it's all about spread. You learned in previous finance classes that IRR must be greater than R to get a positive NPV. The same is true in the real world. IRR is ROIC. The R, the expected return on investment, or what's known as the cost of capital, it's going to be called the cost of capital. And only if you generate a positive spread, the difference between the two, can you create value, positive NPV over time. And so in this class, a 1-year IRR is called ROIC. And it's a proxy for free cash flow. Second cornerstone is that value is going to be created by generating more cash flow rather than just rearranging claims in the cash flow. It's about cash flow, not earnings. And so we're going to spend a lot of time talking about cash flow. Cornerstone number 3, it's about expectations. You're worth the sum of your future cash flows. Excuse me. That's why Bloomberg is so important, because Bloomberg is one of the only tools in the world that actually gets you real-time expectations of the future that are being used by professionals. And without that information, you're flying blind. Tool number 4, cornerstone number 4, is it's about sustainability. Because can you sustain your business cash flows over time? And what does that mean, and how do we analyze it? These are the 4 guiding principles that we'll use throughout the semester. And with these principles, we will then create a concept known as what McKinsey calls the key value drivers, KVD. So this is the math behind those principles. And so really, this is a summary of all the math that we're going to go through the semester, because at a high level, value is a function of 3 things. It's a function of spread, ROIC versus your cost of capital, how fast you grow that spread, and how long you can sustain it. And the return on invested capital is a function of margin and productivity. How much you make, how frequently you make it. So these 5 things become the value drivers: margin, speed, how much, how often, risk, growth, sustainability. And that's what we're going to start to understand for a business, right? Now, about half this spread, this is what we call Buffett's rules, comes from the industry that you're in. This will be one of your early assignments. So again, real world. Let's go to Nike. So if I go to Nike, I go to the equity screen, one of the tools is called RV, relative valuation. This is basically your peer analysis. So this will give me a default list of peers at Bloomberg. And if for some reason I want to change the list from athleisure to some other group, I can actually go to different peer lists. But this is the default list for Nike of their competitors. So chat here, is there a question? Oh, my Bloomberg screen's not showing? All right, try this again. All right, is Bloomberg showing now?
Yes.
Okay, good. So this is RV from Nike. So I'll go back to where I was in case you didn't see it. Nike US equity, RV relative valuation. This is one of the most important, powerful features of Bloomberg, which is it can allow you to do real-time competitive analysis and industry analysis. So here is the Nike industry. You can switch how you want to view the industry, but here's athleisure. It's got all these predefined templates for their peers. And over here, I can go to custom and I can look up any data point that I want. So what I'm going to do is I'm going to add a column, I'll call it ROIC, return on invested capital. And it's going to say, what return on invested capital do I want? I want the ones of the latest filing. Boom, there they are. And then it's going to ask to add a column. I'm going to type in weighted average cost of capital. This is today's WACC for all of those companies. There it is. And the difference is spread. So basically, Nike is borrowing at 8.5%, and last year made 15. Under Armour's borrowing at 8.5%, and last year lost 19 cents for every dollar of investment. Puma borrowed at 9, made 6. And so you can start to see who's doing relatively well, Lululemon, Nike, who's screwing it up, sorry, Kevin, Under Armour, and others, and who's kind of doing okay. And one of the things we're going to learn how to do is we can save this as a template. So I'll just call this 443 spread. So I can reuse it. So let's say I want to replace Nike with Ford. So this will be the auto industry. And you can start to see the autos struggling right now. This industry is doing a lot worse, and the cost of capitals are a lot different. Whereas if I did Pfizer, pharma is actually doing relatively well. And Novo Nordisk is really doing well compared to some of these other companies. And so that's the point, is that one of the Buffett's rules is that the industry is about 50% of the performance of a company. If you're in a good industry, it's a lot easier to make money than if you're in a bad industry. And Bloomberg allows you to assess very quickly industry performance, industry spread. So that's one of the things that you're going to be doing for your first assignments. Okay. Questions about this?
Will there be like somewhat of step-by-step type directions on how to complete some of these assignments, or?
Yes, it's called the Bloomberg Certification.
Okay.
Become certified. And also, I'm not trying to dismiss your question, but that's the point. Like today, there's no training wheels on this bike. I'm going through relatively quickly. But over the next 3 weeks, your certification will help you start to move in this direction. And more importantly, some of the assignments, I'll give you some step-by-step instructions, but you're going to have to do some of this. And I'll slow down when we go through more detailed instructions. But at the same time, today, I'm not putting training wheels on. Good question. Other questions? All right. So back to, and again, I don't have to do U.S. companies. Like, let's say I want to look at ByteDance, that many of you probably have never heard of until recently. Nope. Actually, we don't have that. I'm not going to go looking for it later. But they own TikTok. Again, let's go back. They might be private. I got to figure that one out. Let's go back to what we need to do with Nike. The difference, and I'm for purposes of time skipping to this near last slide. Again, this is in the reading. But the difference between a company and a project is we assume companies last forever, projects come to an end. So when I value a company, what I'm actually valuing is what's called a perpetuity, perpetual cash flow. And this is the formula for growing perpetuity. So I need to know, to value a company, their free cash flow, I need to know their cost of capital, and I need to know how fast that free cash flow grows over time. That's the magic formula in finance for valuing companies. The difference with McKinsey is the problem with the formula that you're taught in the academic textbooks is it has an implicit assumption that the incremental ROIC equals the historical ROIC. Translation, whatever return you make now, you make forever. So if I apply this formula to a poor performing company, I will tend to undervalue that poor performing company because it will never improve its performance. If I apply this formula to a company that's doing really well, I'll tend to overvalue the company because it will never slow down, okay? Never get worse. And so I basically exaggerate the directionality of the cash flows. So what McKinsey did is they rearranged this equation to get what they call the key value driver equation, where free cash flow is profit times 1 minus the investment rate. And sustainable growth is the investment rate divided by the return of the investment. So basically put that in here. So they just rearrange the equation. They call it key value drivers. But what they do is instead of forecasting free cash flow, you forecast profit and ROIC, which basically gets you free cash flow. And the difference is this ROIC is incremental. So you can have a different ROIC for the future than whatever it is for today. And so this is future ROIC. And this creates the key value drivers equation. And fundamentally, this is what you have to understand about value to complete this class. But if you do, you have a pretty good understanding about why things are happening. So I'm going to go to Excel. I'm going to make this bigger so it's easier to see. So let's say we have two companies, company A, company B. And there's four parts of the key value drivers equation. There's expected profit. There's our growth rate. So I'll call it expected growth. We care about future, not past. The expected return, right? Expected return, and risk, which is the cost of capital. That gets me value. Call this cost of capital, just so you're not confused. So let's say we have two companies that have identical profit, 100 million a year. Let's say both companies are expected to grow this profit 5% a year into the future. Let's say company A makes a 10% return on its investment. Company B makes a 20% and it's expected to continue. And their cost of capitals are both 10%. Which of these two companies is going to be more valuable? A or B, and why? Who's more valuable, A or B? When I do the math, I'm going to use this equation and that spreadsheet. Just 1 second. Who's more valuable? A or B?
B.
Should be B, exactly. And the reason why is think of ROIC as cash flow. I'm generating 10 cents per dollar of investment in profit for company A. I'm generating 20 cents per dollar of investment in profit for company B. And I'm growing 10 cents 5% a year versus with company B, I'm growing 20 cents 5% per year. B will be more valuable at the same hurdle rate. Okay, this is the logic behind this. Well, let's do the math. So putting that formula in here, a little bit more, equals profit times 1 minus the growth divided by the return divided by the WACC or the cost of capital minus the growth. Company A would be worth $1 billion. Company B would be worth $1.5 billion. If I were creating a PE multiple, price to earnings multiple, company A would trade at a multiple of price divided by earnings, 10. Company B would trade at a price to earnings multiple of price divided by earnings, 15. Key value drivers. That's why at the beginning of the class, I said for KVD, we do multiples. Multiples are just rearranged DCF. It's a shortcut for DCF, right? And these determine your value and your multiple. Now, what ifs? If A doubles its profits, has a big windfall, but nothing else changes about its business long term. What happens to the value, spell right, of A, and what happens to their multiple when they double their profits? What do you think? When I hit enter, oh, actually I hit enter, sorry, the answer's there. What happened when I doubled the profits? Here's profit of 100. Here's profit of 200. The value went up, but the multiple didn't change. Company B, double. The value goes up, the multiple doesn't change. So one of the lessons of the key value drivers equation is in finance, we call this sizing. When you generate more absolute cash, you become bigger and therefore more valuable. So that's one way to drive value, just make more cash. But you don't become better. People don't pay more for those earnings because you're bigger. Okay. So what drives the multiple, the key value drivers, growth, spread, that's what drives the multiples. It's not how much you earn. It's how fast you grow it, what kind of return on investment you make on it, and how risky it's perceived to be. So, said another way, if I reset this, and if company B were to start growing at 6% a year before I hit enter, forever, grow its profits. So instead of 100, 105, 110 cash profits, it generates 100, 106, 112, et cetera, into perpetuity. Now what happens to the value of A and the multiple of A? When I hit enter, what's going to happen? Is the value going to grow? And is the multiple going to change? All right, well, let's see. This is 6% a year growth in profit forever versus 5. This is 7% per year. This is 8% per year. 9. Make sure I didn't make a mistake. 6, 7, 8, 9. What's going on? Why is B changing and A not?
Does it have something to do with the spread on return and cost of capital?
What's the spread of A?
0.
Therefore, if I create a bunch of 0 NPV projects, what's my change in NPV?
0.
That's the difference. B has a positive spread. I borrow at 10, I make 20. Crunch all you want, we'll make more. A's the treadmill. I go really fast, as fast as I can run, but I'm good anywhere. So this is what I mean by good growth and bad growth, and understanding what's happening with the value of a company. So again, put this in the real world. So I work with a company called Merck, big pharmaceutical company. I want them to understand the share price. So let's show you Merck. Look at that. MRK, US equity. And another feature of Bloomberg is called FA. This is historical analysis. I can look up historical balance sheet, income statement, cash flow data. And besides the statements, I can come over here to custom and I can look up anything that I want, historical data. So create custom, ROIC, find return on invested capital. So there's historical ROIC for Merck, and here's historical WACC for Merck, year by year. Well, look at this period, 14, 15, 16, 17, 18. Look at the spread. Tell me what the graph of their share price probably looks like. Is it a line going up? Is it a line that's flat? Or is it a line going down? What does the academic formula tell us that the share price should do? Given what we just said here.
It was probably pretty level, then went up.
Okay. What happens in 18 and 19?
The return on the ROIC goes above the WACC.
And therefore, that's why you think it will go up, right?
Yes.
Because now you're generating more cash than people expect. Before you're not. Well, this is the graph of Merck's price going back to 2013. Flat up. It's not rocket science. That's what I'm saying. As we go through the semester, you understand these principles, you will start to understand what should be happening to share price. Every now and then you're going to get some wacko stuff that's going on that nobody can explain, right? But most of the time, it actually is explainable if you kind of know what's going on. And that's what equity analysis is about, is trying to understand what's going on, what's driving this. And that's what we're going to be focused on this semester. Key value drivers. And I just gave you 2 of 4 scenarios that are fundamental to understanding what's going on with a company, which says not good growth. I call it the treadmill. If you have growth at a 0 spread, you're not going to change your value. If you have growth at a positive spread, you become exponentially more valuable. And it's not just what you've done in the past, it's what you're expected to do in the future. Elon Musk, Tesla, is not valuable because financially, if I go back and look historically, it's been awful. He's never made money. He's one of the richest guys in the world. Why is Tesla so valuable? EEO. Because by 2023, Tesla should have almost $70 billion worth of cars sold and almost $10 billion a year of Ebitda. This is what the analysts are using when they value Tesla. If you try and look backwards to try and understand what's happening to Tesla's share price, good luck. You might as well be reading tarot cards, right? Because basically, you're not going to understand. It's about the future. That's expectation cornerstone number 3. And you need a tool that helps you understand what the future expectation is, whether it's right or wrong. This is how companies are being priced. And so this is what's important to understand. So that's the point. Tesla in the future has good growth, and you forecast that out. They're one of the most valuable companies in the world. Their PE is actually 158. Right? Scenario number 3, by the way, is what happens when that growth starts to slow. 5% becomes 4% because you mature, becomes 3%, becomes 2%, becomes 1% because your industry slows down, like all industries become mature and disrupted. Well, guess what? Your multiple is going to come down. Not because you're doing poorly as a company, you can still make a great return, but as your growth slows, your multiple naturally gets smaller. Scenario number 4, you have a negative spread. When you grow a negative spread, it gets worse and worse and worse. This is bad growth. You might as well be just flushing money down the toilet. So these are the companies that are basically saying, hey, doctor, you know, my head hurts. Why does your head hurt? I'm banging against the wall. Stop banging it against the wall. So stop growing. Matter of fact, shrink. Shrink a negative spread. These are the core principles, key value drivers. Now, obviously, we can't just end here for finance for a semester. We got 14 weeks of academic detail to get in, far more than we've gotten here. But these are the core principles that we're going to be going through this semester. Okay. And let me show you one last thing about how these formulas apply in the real world. So let's say I'm trying to understand what's going on with the S&P 500 index. So using the formulas, what is my expected net income? Well, for my expected net income, I go to Bloomberg, I type in SPX, index, I go to EEO, and what Bloomberg is doing is it's taking the 500 companies EPS that the analysts have guessed in the future and that they've reported historically and adds it up on a weighted basis. And this is the EPS of the S&P 500 index. And what you can see is that the earnings for next year, year Y plus 1, are expected to be $165 per share, which is a 13% growth. And you're like, how in COVID-19 could this possibly be? And the answer is because this index is looking at the tech companies, and the tech companies are booming right now, tech heavy weighted. And that's what's driving the EPS growth. And by the way, another 17% 2 years out. So essentially 165.29 is what the market's using today for next year's EPS of the index. 165.29. Next, I need to know what is the expected growth in that net income. And I need to know my expected return on equity. Since I'm doing net income, it's return on equity. So here's the thing. Next year, the analyst forecasts book value per share to be $998.75. That's equity per share, common equity per share of the S&P 500 added up, $998.75. So take this divided by 998.75. That's the return on equity that the S&P 500 is expected to generate next year. It's about a little under 17%, 16.55. What is the discount rate? What is the cost of the equity? So I'm just discounting an equity cash flow. Well, I need to know the equity risk premium for the US. So I go to country risk premium, CRP. This is the equity risk premium in real time calculated by country. Scroll down to the United States. Right now, 8.54%. That's a 0.72 basis point yield on the 10-year treasury and an RM minus RF in the CAPM of 7.819. Added together, 8.54%. Actually, what they do is they calculate this. They know the 10-year treasury. They back out the risk premium long term. So essentially 8.54% is what the market's expecting if you're an analyst today for a big company. 8.54%. So here's the deal. If I look at the value of the index and the PE with no growth, that would give me an S&P 500 of 1935 with no growth and a PE of 1175. Well, this is my observed PE. Right now, EEO, the S&P 500 is trading at 3507.98. If I divide that by last year's earnings, that's 27.3 PE based on last year's earnings. If I divide by 3508 divided by next year's EPS of 165.29, that's a PE of 21.22. So the market is today trading at 21.22 times next year's earnings. Why? Growth rate, 4% per year. 5, 6, 5, 3, 5.35, close enough. By the way, that's an index value of 3506, and right now we're at 3508. That's what the market's using today. That's how it's being priced. That's the cost of capital. That's the expected return on equity, the ROI. That's the per year growth that the market's using in EPS long term. And that's the EPS next year that gets you a market that's trading at a PE of 21. Key value drivers. Now, if we look at risk at what's going on in the marketplace, a few months ago, this number was 9.5%. Interest rates have been coming down. People's expectations are getting lower. If interest rates start going back up, market's going down by 20 to 25%. 1% change in cost of capital. It's 25% decrease in the S&P 500 index. If these companies grow at 4.5% a year instead of 5.3, because basically everybody going to college is just an example of how effed up the world is, and commerce starts to slow down. The government doesn't bail it out. These companies just don't grow as fast. Stock prices will go down 15% by having less growth than what we thought. Now, I'm not saying any of these are going to happen. These are scenarios that we can run. We start to understand how these scenarios will affect our share prices. Equity analysis. Questions? About any of this? Good news is what I did relatively quickly today, within a week or two, you guys are gonna be zipping through this. So here's what you need to do. If you don't have the 7th edition, I'd recommend getting the 7th edition. All right. Number 2, get a Bloomberg account. Start playing with this yourself. Start the certification. There's a 5th module, which I did not make mandatory, which is an introduction to the terminal. Okay. I will tell you the terminal was created back in the 80s. You'll notice I'm typing in a lot of keyboard shortcuts. They haven't updated the graphical user interface. So it can seem a little daunting for somebody that grew up, you know, in a generation where everything is kind of like, you know, touchscreen. But regardless, this is what you have to learn if you go become certified. Start the certification. Meet your teammates. Find out what team you're on. Start connecting with your teammates. All right. We'll pick up here on Wednesday. There'll be an assignment on Wednesday, which will involve Bloomberg. Not a big assignment. I'll walk you through how to do it, but it'll be due the Wednesday you get back from Labor Day. That'll be the first graded homework assignment. Right? Other than you can feel free to start the certification. All right? Welcome to the online version of 443. This class was recorded. Again, I will post it. Either it's available on the Zoom link or it'll be on YouTube later today. Okay. Have a good day. See everybody on Wednesday.
Thank you.